Are you operating a cross-border business between Canada and the United States? Well, what you don't know about Canadian tax laws can cost you time, money, and hassles, which is why I'm going to tell you about a lot of these tax traps that really trip up a lot of U.S. businesses and how you yourself can avoid them. Hey, how are you today? I'm Duncan McPherson, and I'm a CPA in both Canada and the United States. Best of all, I specialize in international taxation and especially these cross-border tax traps. So for more information, check me out at themactax.com. And don't forget to subscribe for more tips on how you or your clients can avoid these traps and pitfalls without all the BS you're probably currently experiencing. Today, I'm going to expose some critical tax traps that you're going to be dealing with when it comes to Canadian operations. And let me tell you, understanding these is going to save you from hefty fines and a hell of a lot of legal headaches. So let's ensure your business is protected. Now let's talk about this first trap, and it's a doozy. Upstream loans from your Canadian subsidiary to your U.S. parent company may be recharacterized as deemed dividends here in Canada. In the USA, upstream loans to foreign parents are usually okay, but in Canada, it's going to be a real quagmire for you. And what you might not know is that this recharacterization actually subjects your intercompany loan to dividend withholding tax just for being a loan, and even if you pay it back the following year. And you misunderstanding this can lead to unexpected tax liabilities, plus interest, plus penalties, which, let's be honest, it's the last thing you want to worry about when you're financing your operations. And let me tell you, the time and hassles are agonizing if you have to deal with this. So at the end of the day, there is no planning. You cannot do upstream loans from a Canadian subsidiary to a U.S. parent, period, end of sentence. So be sure at your end, there are no upstream loans on your Canadian subsidiary's balance sheet. But don't worry, because if this is something you have been inadvertently doing, just reach out to me at themactax.com and we can sort it out together. No problem. Now let's talk about the second trap, LLC recognition issues. So unlike the US, Canada will not recognize the flow-through nature of an LLC. Under Canadian tax law, they are treated the same as a C Corp. So unlike the US, Canada will not recognize your LLC as a flow-through entity. Under Canadian tax law, they're going to treat you as a C Corp. As you probably already guessed, this discrepancy is going to cause you a myriad of compliance issues and a mismatching of foreign tax credits. So to avoid these pitfalls and ensure you get optimal tax treatment on both sides of the border, it's crucial to structure your cross-border affairs appropriately from the get-go. And also, not a pitfall, but just a hoop you may have to jump through. If your LLC is required to file a tax return in Canada, it may be required to get a status letter from the IRS showing that the owners of the LLC are U.S. tax residents. That's all. So, pitfall number 3, differences in depreciation policies. And I warn you all now, this one is a shit. So the way depreciation is handled can significantly affect your tax liability. And here's why. Canadian depreciation methods vary drastically from the methods you're privy to in the United States. ADS, makers, and bonus depreciation, which will lead you to substantial tax liability with GILTI and Subpart F income. In fact, quite often, and in fact, this is a recurring nightmare in my practice, the GILTI tax is really just a tax on depreciation differences. Fortunately, in Canada, we have great flexibility in our treatment of depreciation, enabling us to mitigate this nightmare for you. Ergo, someone on your tax team must know both countries' depreciation methodologies. And if you currently do not have someone on your tax team that does, give me a call at themactax.com and I'll get you sorted out right away. And the last trap we'll discuss today is that we do not file consolidated tax returns in Canada. So any consolidation strategies you use in the United States are out the window up here in Canada. So let's say you have 2 Canadian subsidiaries, one that is profitable and one that's losing money. In the USA, you can consolidate these 2 companies where their combined taxable income is zilch, right? Well, no such luck up here in the Great White North. Your profit company pays tax and your loss company sits on the loss as a carry forward until it's profitable. And if you have in the back of your mind right now that you can just charge a management fee from one company to the other to offset it, forget it. I know economically this seems totally unfair, but that's just the way it's done up here. You just got to live with it. So if these complexities are giving you headaches, don't navigate these treacherous waters alone. Schedule a consult with me today at themactax.com. I will help guide you through these complex tax laws, both from a legal standpoint and a compliance standpoint. I'll guide you through these complex tax laws and ensure you stay compliant and minimize your tax obligations. Or better yet, just click the link below and secure the health of your cross-border business. And let's tackle it together, and thanks for watching. I'll see you in the next video.